I'm Michael Lear, a newly minted board member here at ICF. And in my day job, I'm a private wealth advisor for Capital Group here in New York. I'm actually sitting here at my home in New Jersey, but one day, hopefully soon, I'll be back in the city. But thanks for joining us. Before we get started, I'd like to share some background with you on the Impact Capital Forum. The Impact Capital Forum was founded in 2003 and was previously named the Microfinance Club of New York. Since that time, we've expanded our scope to address all aspects of financial capital, human capital, technology, and natural resources that benefit the world through the lens of financial services. ICF now has over 3,500 individuals in our network. Most members are professionals with a background in financial services, financial inclusion, fintech. However, membership is open to anyone that supports the club's mission. We host approximately 25 events per year on a wide range of topics relevant to impact investing and social enterprise. For example, next week, we'll be hosting a fireside chat with Karen Sherman, who is the author of the book Brick by Brick. So if you enjoyed today's discussion, and I'm sure you all will, I encourage you to consider membership. It's relatively inexpensive and a great way to show your support for our community. And with that, I'll hand over the mic to Bhakti Mirchandani, who will be moderating today's panel. Bhakti?
Thank you, Mike. I'm so pleased to be here with our esteemed panelists and with all of you in the audience to discuss actions that the Biden-Harris administration can take across the investment value chain to accelerate the transition to a sustainable economy. The Biden-Harris administration would be lucky to have any of our panelists in positions of authority, and you'll see why in a minute when I share their backgrounds. Samantha Ross is one of the founding staff of the Public Company Accounting Oversight Board, and helped to build it from the ground into the world's largest and most respected audit oversight organizations. She founded and leads AssuranceMark to continue to serve investors' interest in high quality, reliable reporting and assurance on material disclosures beyond the financial statements. She built the foundation for the PCAOB's bilateral agreements with 30 audit regulators in Europe, and she testified before the Financial Services Committee of the House of Representatives. She was special counsel at the SEC, a law clerk to the Southern District of New York, and an associate at Sullivan and Cromwell. Jon Lukomnik is the managing partner of Sinclair Capital, a strategic consultancy to institutional investors and a senior fellow at the High Meadows Institute. His newest book, Moving Beyond Modern Portfolio Theory, Investing That Matters, will be published in April. He's been the investment advisor or trustee for more than $100 billion at institutions as diverse as Deloitte and Van Eck. He was a visiting professor at the University of Cambridge, led IRRC, co-founded the International Corporate Governance Network, and was an officer at the Council of Institutional Investors and a member of the Standing Advisory Group of the Public Company Accounting Oversight Board. Hui Chan leads Citi's climate efforts, including the implementation of the TCFD recommendations on climate-related risks and opportunities, and the development of Citi's 2018 and 2020 TCFD reports. She also supports sustainable finance and other cross-functional initiatives that drive environmental and social impact with clients and other stakeholders. She served as the North America representative of the UN Environmental Program Financial Initiative Banking Committee from 2017 to 2020. Previously at Citi, she was the Impact Analytics and Planning Officer at Citi Foundation and the Vice President on the Corporate Sustainability Team. And she's a Harvard Business School alum. Having set the stage, we can spend the remaining time focused on sustainable investing policymaking, rule writing, and regulatory enforcement. Sustainable investing encompasses ESG integration, positive and negative screens, impact investing, sustainability-themed investing, and investment stewardship. The scope of our discussion spans the investment value chain from issuer disclosure to climate stress tests of financial institutions, and ultimately to sustainability taxonomy that investors use. So let's kick off with a question for first Jon and then Samantha. What's happened from a sustainable investing policy perspective over the past year or so, and why is it important?
Thanks, Bhakti. First, thanks to Mike and to the Impact Cap Forum to invite us. We have a lot to cover in limited time, so let me just apologize in advance for all my answers If they're not in sufficient depth for anyone who's watching, feel free to just direct email me and I'll try to answer it in more depth. So I think what's happened in the last year regulatorily all stems in large part from a President Trump initiative to increase the use of fossil fuels. I know that sounds strange when the rest of the world is heading in the other direction, but that's what happened. He asked his cabinet what each agency could do to promote fossil fuel use. As a result, a number of agencies took aim at sustainability issues and at sustainability advocates, quite honestly. To me, I'll just highlight one and we can go into others later. None were as vicious or quite honestly as clumsy as the Department of Labor. The Department of Labor, for those of you who don't know, governs how pension plans, including your 401k, can be invested. And DOL proposed two rules. The first would have created severe hurdles for any pension plan to consider any environmental, social governance issue as in terms of investing. So you couldn't invest in sustainability funds, you couldn't invest in low carbon funds. Technically you could have, but the hurdles that it would have created would have had a tremendously chilling effect. The second would have limited proxy voting on ESG issues. And they were trying to create a chilling effect. Honestly, the proposed rules were incredibly sloppily prepared. DOL tried to rush them through. For instance, allowing only 30 days comment rather than typical 90 days. It did so to try to get the rules in effect under the Trump administration before the January 20th transition. In fact, the proxy rule only takes effect next Friday, January 15th, to tell you just how rushed they tried to make it. Despite its attempts to ramrod the rules through, the department received thousands of responses, and I am sure Sam from working in government can tell you just how unusual that is. Normally you get scores, maybe 100, maybe a couple of hundred. It got thousands of responses, and because they were such ridiculous rules, 95% of those responses were in opposition. So one optimistic takeaway is that even the mainstream financial community rallied to support the ability to consider ESG and impact matters. What finally happened is DOL walked the rules back. They walked the first one back substantially. In fact, the first one doesn't even mention ESG in the actual rule. It just states trustees must consider pecuniary factors in making investment decisions. The proxy rule was also rolled back somewhat to be more principle-based. Overall, there's still minor hurdles to sustainable investing, but small ones that most investors will be able to overcome. So I guess the follow-up is, what's the Biden administration like to do? Overturn the rules somehow. And there are a lot of possibilities. The new DOL could embark on a new rulemaking. It's time-consuming and effort, but it could, in fact, result in rules that say you have to consider sustainability. The administration could ask Congress to rescind the rules, which is what the Republican Congress did to many of the rules the Obama administration proposed at the end of its term. And it could go to court against its own rulemaking, saying that, in fact, the rules were initiated to promote fossil fuel consumption, not, as the Trump Department of Labor said, to protect pension plan participants. Lying about the rationale for a rule is, I believe, automatic reason for invalidating under the Administrative Procedure Act, or, and I think this is most likely, the new DOL could just promulgate guidance that ironically turns the intent of the rule, which is anti-ESG, on its head. And it could do that by finding that ESG issues presumptively have pecuniary value. In such a case, a pension plan would have to consider them or make a case for why it does not. And I like that as an answer, both practically, it doesn't have to go before Congress or a court, and the wonderful irony that a rule which was designed to discourage ESG, in fact, in the end, could wind up turbocharging it. So I'll stop there and go on to Sam.
Great, thank you very much. I want to thank you, Bhakti, for that lovely introduction of both me and Jon. I'm so honored to be on this panel with Jon and Hui. And I also am very grateful for the Impact Capital Forum for having this panel at this very important time. So just to stay in the same vein that Jon was, to talk about what the work the Biden administration has before it, I think it is important to understand where we are today and what's happened in the last year in regulation. And Jon spoke about DOL regulations. There were also 3 SEC, new SEC rules, Securities and Exchange Commission rules, that I'd like to highlight because they will, I think, have be things that the Biden administration will have to grapple with. And in addition, they will be things that this community will have to grapple with over the next few years. So the first one that I want to mention is very related to one of the rules that Jon mentioned, and that is the SEC's own rule on proxy advisors. There had not been an SEC rule or regime to oversee proxy advisors, and that is the subject of the new rule that the SEC put in place. It's extremely controversial. It did essentially 3 things in summary. First of all, it codified the commission's new interpretation that the advice that proxy advisors provide to their clients constitutes proxy solicitation. By doing that, that invokes an entire, long-standing regime of requirements and regulations on proxy solicitors, and makes proxy advisors dependent on exemptions that the SEC then laid out, because the rules on proxy solicitation are just wouldn't even be tenable or cost effective for proxy advisors to follow. And those exemptions are, first of all, enhanced conflict of interest disclosure. That's not particularly controversial. Also, this was a little bit of a walk back from the original proposal, but they are required to make their advice available to companies that are the subject of the advice. And then somewhat more controversially, they are also required to provide a mechanism for companies that are the subject of proxy advice to comment on the advice, to dispute the advice that has to be provided by the proxy advisor. And then very importantly, the SEC added a note to it, what's known as its Rule 14A9, which essentially makes proxy advisors liable to companies for their advice. That is really a sort of Damocles that is hanging over proxy advisors' heads. So it should be of great concern to the clients who use proxy advisors for their advice. Remains to be seen how that will play out, but that's ultimately what happened with the rule. Now, that rule is already the subject of litigation that was brought by one of the top proxy advisors, ISS. So we will be following that litigation. It's midstream right now. The subject of litigation is that the SEC violated the Administrative Procedures Act in the way that it promulgated the rule. So it's possible the litigation could abrogate that rule. Otherwise, that's something that the new commission under the Biden administration will have to deal with. The second rule I'd like to talk about is changes to the longstanding shareholder proposal process, Rule 14A8. The SEC proposed a wide-ranging set of changes to shareholder proposals. I don't think I'm happy to talk about it in detail if anybody is specifically interested, but in the interest of time, essentially what those changes do is limit the number of shareholders that will come to vote. And I think that's how it really impacts this community. The areas of change are to increase the ownership requirements. So you have to own a lot more stock in order to be able to file a shareholder recommendation. They also increase the resubmission thresholds, so that if a proposal doesn't meet the new higher thresholds, it can't be resubmitted. Anybody who follows shareholder proposals know that there's sort of an arc of development of proposals. A lot of times they're in the early years, the proposals don't garner a lot of support, but they build support over years. So this is meant to really kind of nip in the bud proposals that aren't immediately extremely popular. They also impose new requirements on shareholders who file shareholder proposals to be available to engage with companies during a very short window of time and limited the kinds of representatives that shareholders can use in filing proposals. Again, all meant to reduce the number of shareholder proposals that can be issued. And I think the way that impacts this community is that one of the ways that, if you're following a sustainable investing program, one of the ways you can do that is through expressing your preferences in voting. And if there are fewer shareholder proposals available to vote on, that signaling is reduced. This rule, as with the proxy advisor rule that I just mentioned, do not go into effect immediately. So they are on the books immediately, but they will be implemented starting with not this proxy season, but next proxy season. So you will not see the impact of these rules this proxy season. It may feel like everything's the same, and that's because it is. The old rules are still applying this year. The changes we'll see really starting next January. And as I said, the proxy advisor rule is subject to litigation already. The changes to Rule 14A8, no cases have been filed yet, but there has been talk of some. Now, the last rule that I'd like to talk about is actually not as negative of a story, and that is that the SEC amended its longstanding regulation SK on disclosure that must accompany the financial statements that companies file. There were a lot of things that investors found disappointing about this rulemaking, so I don't want to mislead you in that regard. But one change to the rulemaking was that the SEC clearly came out and clearly said that the company should provide a description of registrants' human capital resources. That's the clearest statement they provided yet on that topic, and now they very strictly followed a principles-based approach. So what I just said to you is the extent of the requirement. I think companies are now grappling with how to implement that requirement. The SEC has encouraged that companies consider disclosing the metrics that they use to evaluate and monitor human capital, but of course, only to the extent it's material. That's something the SEC emphasized. So, this will take a lot of focus by the commission, the new commission, by investors to see if the new disclosures are really satisfactory. And the commission may itself, this is an opportunity for the commission to provide additional guidance to, hopefully garner more specific and more comparable disclosures from company to company. So I'll stop there. Those are three very important rulemakings. I think, it's important to be aware of, to monitor how the SEC in the next few months and years implements those changes, and, whether any of them are rolled back.
So we'll dig a little bit deeper on some of the other regulatory agencies. So the actions of the Trump administration at the Department of Labor and the SEC have received the most of investors focused about sustainability last year. But there are lots of other less focused on agencies that we should expect to hear from. How are the other federal financial disclosure regulators going to play a role? This is a question for first Jon and then Sam.
First, I just do want to mention something about the SEC. It's clear that the Democratic commissioners on the SEC support increased ESG disclosure, probably along the lines of what's going on in the rest of the world. So that would mean some combination of TCFD and SASB. So I do expect that to happen. Second, an agency that's not an agency called FASB, the Financial Accounting Standards Board, where promulgates rulemaking in accounting. And Sam's going to talk about this, but my only point is they are beholden to the SEC. They can't do anything without the SEC. The SEC can, in effect, exert pressure on them. Sam, I think, may mention some of the things they can do. The other thing, the agency that's not an agency, because Washington works in strange ways, is the PCAOB. And as you heard in the intros, both Sam and I have affiliations or former affiliations with it. That is the regulator of the auditors. The US splits from the world in how it does accounting and auditing. The international auditing standards and accounting standards now are emphasizing that current standards require auditors to take a skeptical look, what's called professional skepticism, on how companies report things that can be affected by climate change. So if you have a fleet of gas-powered vehicles, even, so you don't have to be an environmental, a fossil fuel company. I have a truck. How long do I depreciate that for if it's gas-powered as opposed to electrical powered? Just all sorts of things. I would hope that that would make it to the US as well. Then let's face it, Joe Biden has certain priorities that he has said he's going to have. Climate change is one, racial and economic justice is another. The Office of the Control of the Currency is trying to promulgate a rule that says that banks must lend or cannot unilaterally not lend, I guess is how it's being phrased, to things like drilling in the Arctic Reserve or coal-fired plants. That's not going to fly. It's gone. I mean, it was silly to begin with. Even the American Banking Association opposes it. To tell you something, everything the government purchases can have by executive order sustainability metrics around them in terms of scoring for purchases. The Federal Reserve has finally come out and joined every other bank, including the Bank for International Standards, in saying climate change is a financial risk. Imagine if it hadn't been held back by the Trump administration. And the last thing, which is of particular interest for the impact investing community, because I think it's going to create a bunch of opportunities in the future, is Joe Biden has said he wants to concentrate on infrastructure. What sort of infrastructure gets built will matter, both for racial and economic justice, but also for climate change. Is it housing? Is it roadways? Is it electric charging stations? Is it in a public-private partnership, which is what's most likely and what most of the advisors around Biden have suggested, where there will be opportunities for impact funds to invest alongside governmental funds. So I think there's going to be a huge catch-up, in effect, with what is similar, has gone on in Europe for the last 2 or 3 years, because all the other aspects of the United States line up to what has gone on in Europe in terms of their public policies, and now the administration does as well.
Great. We'll hear from Huey in a minute on what's going on in Europe, but first we'll go to Sam on some of the other smaller regulatory agencies.
Yeah, great. So we talked about new regulations that the SEC put on. I would expect there will be new ones in the Biden administration. But one thing I think is very important not to get lost is one of the most powerful tools that the federal regulators have, the federal financial regulators have, is their enforcement tools. And I don't, by saying enforcement, I don't just mean litigation tools or suing in cases. What I mean is their oversight and monitoring and their ability and authority to engage directly with companies and demand improved disclosure. I think this is going to be tremendously important for investor protection and for increasing, improving the quality, the rigor, the depth of disclosure. And as Jon has been saying, we're really kind of behind the 8 ball on this. And I think that the Biden administration, this is something the Biden administration really from day one can just, jump ahead and start catching up. I think that, let me focus on the SEC, the PCAOB and FASB and what they can do. The SEC has a program to monitor 10K filings, IPO filings, asking companies questions, getting companies to improve disclosure. They have not used that authority in recent years, in many recent years, actually, very much to promote improved disclosure about the effects of climate, about the effects of other ESG or sustainability matters that may nevertheless be financially material. The SEC has said these matters can be financially material. They just haven't been enforcing the rules. I think that's something that can change on day one. The SEC can start enforcing those rules. At the same time, I think the Public Company Accounting Oversight Board, which oversees audit firms, can also play a big role by emphasizing in the PCAOB spends a lot of its resources inspecting the work of audit firms. And once the PCAOB signals that it's looking for how auditors are evaluating accounting matters that are affected by climate. I think you'll see the audit firms really step up and be, encouraging their own clients, the companies, to improve their disclosures. So we can see, I believe we could see some change even in a period of one cycle, very quickly, some deeply much more robust disclosure. In addition, as John mentioned, abroad, there have been a lot of statements explaining how existing accounting standards and other disclosure requirements apply in the context of climate change. Specifically situations like how do you measure impairment, if that is that affected by the physical risks of climate change, the transition risks. Absolutely, as we've seen a lot of write-downs both abroad and even here, related to changes in things like long-term oil and gas commodity prices. That's a straightforward accounting matter, but it certainly has a lot to do with revealing the impacts of climate change and the transition to a lower carbon economy. I think that will be something that the Biden administration, both the SEC, the PCAOB, and FASB can get working on right away. In addition, the IAS, the International Accounting Standards Board Foundation, has recently put out a comment to establish a new sustainability standards board. The IASB, International Accounting Standards Board, is kind of a cognate of the FASB here in the US. So I think that begs the question, what are we going to do in the US? Are we going to do something similar to that and establish a real sustainability standards board? That's going to be a very important question for the new Biden administration, SEC officials, because the SEC oversees FASB, as John mentioned. That'll be, right out of the box, a very important question. And then in addition, I did see someone already asking the Q&A about the Democrat commissioners on the SEC have already, in the last few months, been calling for a new advisory committee at the SEC on ESG matters. And I would expect that committee to absolutely move forward. It's, been talked about a lot here in DC. I think it really does have legs to go to the question that the questioner asked. And I think it'll be very important to watch that and to participate in initiatives like that and forums like that, because it's all about getting investor input. That's what the SEC needs.
Great. Outside of the US, Huey, regulators and policymakers have different interpretations of materiality and different understandings of disclosure requirements, and Europe is further ahead. Your knowledge and perspective would be great to hear.
Sure. So as John and Samantha mentioned, disclosure is a really important enabler of sustainable investing and in building confidence in the kind of sustainable investing sector. In Europe, the definition of materiality that they are used is not just the definition of materiality used by the SEC here, which is really around information that would inform an average investor's kind of investing decision. In the EU, they use a definition of materiality that is often referred to as double materiality, where it's not just about whether an issue is going to impact a firm financially, but also how your actions as a company can have an impact on, for example, climate and the environment. The disclosure regime in the EU, as well as in other parts of the world, has evolved pretty rapidly over the last few years, with the recognition that improved ESG disclosures not only enable investors to make better investment decisions, but also enable regulators and central banks and supervisors to do a better job of understanding risks that may have an impact on the financial system. So there have been an explosion of regulations globally. As a result, a firm called Datamoran says that they've tracked over 5,500 non-financial related regulations and initiatives around the world over the past few years. And for companies that are disclosing, this can be really, really overwhelming, especially for multinational companies that are expected to follow rules and regulations in multiple jurisdictions. So one of the things that has really kind of come up recently is this notion of global harmonization of policies and regulations. And so a great place for the Biden-Harris administration to start is really by looking towards the EU and other regimes that have made more progress in the space. And to make sure that whatever regulation the US passes, whether it's through updating the SEC's Reg SK, as Samantha previously mentioned, or something new, that it is aligned where it makes sense. So on the climate front, as Jon noted, the TCFD is the kind of main framework that has been gaining the most traction. Over 1,000 companies have already come out in support of this framework and are beginning to adopt it. It's also been incorporated by organizations like CDP and PRI into their disclosure templates for companies and investors. On the regulatory front, the EU's non-financial reporting directive, which sets out the minimum level of climate and environmental information and ESG information that European companies need to include in their annual report, has updated their guidelines to include the TCFD recommendations. This is currently voluntary, but that might change. Last year, we began to see some countries, some jurisdictions starting to mandate its adoption. So for example, New Zealand announced a new policy in September last year, requiring all banks, asset managers, and insurance companies with over $1 billion in assets to disclose their climate risk in alignment with TCFD. And in November, the UK followed. The timeline for adoption is 2023 for the New Zealand regulation and 2025 for the UK. Here in the US, Senator Elizabeth Warren has urged the SEC to do the same. So last year, she introduced the Climate Risk Financial Disclosure Act, and I would not be surprised to see it brought back in this new Congress. In addition, the EU and jurisdictions around the world, like Hong Kong and Singapore, are also starting to issue guidelines on climate and environmental risk management. So it's not just about disclosure, it's about how companies are managing these types of risks. And they're also asking financial institutions, banks, investors, and insurers to start climate stress testing. This is a really emerging area. Last year, Senator Brian Schatz introduced the Climate Change Financial Risk Act, which urges the Federal Reserve to start climate stress testing. The Fed recently joined a global network called the Network for Greening the Financial System of central banks and supervisors. And there are active conversations and debates about whether global regulators should conduct a joint climate stress testing exercise so that people can collectively learn, or whether individual exercises, which can potentially place a lot of pressure on financial institutions, given that this is such a new emerging area. The CFTC formed a climate risk subcommittee last year to offer kind of thoughts on climate-related recommendations. So I would encourage everyone to look at their report. There are over 50 recommendations, and they didn't cover just what the U.S. government should do, regulators should do within the commodity space. They also had recommendations for other agencies. So for more kind of ideas, thoughts, and on what can happen on the climate front, I would encourage everyone to take a look at that report. So more broadly on ESG disclosures, the EU also has their Disclosure Regulations Act, which expands beyond climate to cover ESG related risks into kind of investment decisions and recommendations. These guidelines, the requirements of the disclosure regulation will apply to investment managers, even if they do not focus on ESG and have an ESG mandate. It's part of a broader kind of package of legislation designed to promote sustainable finance. Another one, which is really critical, is the EU kind of taxonomy regulation and the EU taxonomy, which is basically a taxonomy for classifying what can count as sustainable investments to tackle concerns around greenwashing of financial products. This regulation will also apply to the UK, even though the UK has withdrawn from the EU. So one last area I'll mention is the proliferation of ESG ratings firms and data providers. as the information they're providing kind of grows in usage and in importance, the accuracy of the information they provide and how they're regulated is probably another area where I expect to see a lot more attention focused on over the next few years. So I'll pause there.
Great. Thank you for that wealth of information. There are broader sustainability trends in investing that will continue regardless of Trump or Biden. So maybe we can hear from Jon and Sam on systemic risk and enforcing rules and anything else they'd like to add.
Sure, I guess we'll keep the same order. Huey, that was great. So I'm going to use that as a segue because I think that some of the things that are going on in Europe are indicative of the big trends that would continue no matter who's in power. First, there is a focus on, as Huey said, double materiality, and I want to explain why. What we have always thought of as materiality is, in effect, what the world does to your company. What double materiality says is there's also a feedback loop of what your company does to the world. And increasingly, investors have come to realize, I mean, you invest in the S&P 500 or you invest in an ETF that's diversified. There are very few people who own one or two stocks. And so the health of the market overall matters to you. And in fact, the academic studies say that market movements affect between 75 and 94% of your portfolio compared to anything else like what stocks you actually chose. And the 75 to 94 varies depending on which academic study you read, but it is an overwhelming portion. And so increasingly investors are looking at this and saying, we actually should care about the systemic health of the economy. And so you see things like in the FRC is an agency in the UK that regulates both auditors and investors, interestingly. And they are the keeper of what's the stewardship code in the UK. And their stewardship code 2020 says to institutional investors, you have to disclose what you've done to engage with other investors to deal with systemic risk issues. And so I do think this focus on systemic risk matters, and impact investors in particular are loving it. It is what my co-author Jim Hawley and I called corporate governance 3.0, or what PRI called stewardship 2.0. So you see people doing things like, how do we combat antimicrobial resistance? Climate change, gender diversity are obvious. Everyone, let me talk about some of the other things we're doing. Safety in mining. We may think of mining as an old school thing, but if you have an iPhone, you actually need mining companies. Well, how do we make sure that you don't have another thing like a disaster that happened in Brazil, where it killed 254 people and sent toxic waste for 30 miles downstream? And so investors are no longer dealing with it on a company by company basis. They're engaging mining companies throughout the world. They're engaging the entire Indian manufacturing system and government so that you don't get groundwater, so that bacterial from where pharmaceuticals are manufactured, so you don't get a buildup of antimicrobial resistance. And so this focus on systemic risk matters. And that's the biggest trend. I want to mention one other thing that you mentioned about the data that's out there. One of the things that people don't appreciate, but that is becoming even more so with the advent of big data and AI, is disclosure used to be a one-way disclosure, right? Companies disclosed, investors absorbed. We now get Twitter scrapes. We get information from competitive areas. It is not just a dialogue, but a cacophony out there. You can have more and more information. And so the other trend that's happening, as Huey said, is in the data world, and all investors are data junkies, is how do we make sense of all this data so that we're not what I call drip. Drip is data-rich, information poor. We want to be information-rich as well as data-rich. So that's the other trend that's going on. Systematic investing and trying to figure out how to make sense of signal to noise so that we actually have information, not just data.
Great. Sam? Samantha?
Great. Well, I couldn't agree more with what Huey and John have said. I think that as we see the kind of economic changes and policy changes that they've discussed, all of that really does need to feed through to disclosures and company accounting. I mean, back to the CFTC subcommittee report, there were, as Huey said, numerous recommendations, but probably the leading recommendation was that we establish a national carbon price. Now, whether we do that or not through regulations that will or legislation that would be probably beyond the permit of the SEC or the financial regulators that we've been discussing today, that kind of change would dramatically impact companies' financial statements. And, the SEC really should be on the case to make sure that companies are explaining to investors in advance what those kinds of changes would be, and, how those kinds of changes would impact the company. And then once they're happening, how those changes are impacting the company. Accounting today is largely based on estimates of future cash flows. And of course, I can't think of an issue that's going to impact future cash flows more than climate change would. But of course, numerous other ESG topics as well. There's been pent up demand for better disclosure. And I think that to John's excellent point about data versus information, it's the disclosure regime, which is really where we, ought to be able to expect to get true information and insights that investors can act on. So I think, the SEC, as I said before, has a lot of tools to start making sure that investors are getting the information they need to see how changes in the economy are impacting companies, as well as how companies' actions are impacting our economy. The SEC has a broad remit for disclosure, and arguably already, even the disclosures they have on the books, the requirements on the books, want to really cover that. Some new areas that I think we'll start seeing and that investors should really be looking for, and signaling to the SEC that you need to have a good handle on, because it's very much going to impact investors, is in the area of financed emissions. The banks have recently announced a new initiative called the Partnership for Carbon Accounting Financials. And now not all banks are in that what we call PCAF, but many are. Many very, very significant banks are, and even banks that aren't may still be adopting climate related commitments and pledges that relate to their lending portfolios. And of course, those kinds of commitments about reducing emissions, or at least being transparent about emissions, that's going to trickle down to the companies that are actually the ones making the emissions. So under SEC's regulation SK, long-standing requirement in the management discussion and analysis to discuss capital, access to capital and financing risks. I think you'll already, you should already start to see how changes in the markets and changes in the behavior of market participants like banks and their lending portfolios are impacting companies. That's something you're already entitled to today. I do think you'll see the SEC in particular do new rules related to advancing, new frameworks around, for example, I think it's kind of a no-brainer to adopt the TCFD framework. They probably could even do that through guidance, but they could do it also through a more established rulemaking. How they're going to deal with, sustainability frameworks that are out there today. This plethora of sustainability reporting that's happening outside the SEC's documents and purview and jurisdiction. I think that's something the SEC is going to have to address to make sure that investors are getting rigorous, real, reliable information, and the SEC is in a position to ensure that. So we may see new rules, or at least changes in the SEC's approach to how they've been very lenient in letting companies just put a lot of sustainability disclosure in sort of CSR reports or voluntary reports that may be meant for other stakeholders. So there's so much opportunity for the Biden-Harris administration to make changes in the disclosure policy that will support these other broader policy changes that that Biden and Harris have committed to.
Great. I'd like to take a minute and speak about the rise of S, or diversity, racial justice, and health and safety. Over the past year, and increasingly today, we've seen a heightened focus on diversity and inclusion. One of the venture managers in our portfolio at Trinity Church Wall Street is collaborating with a number of other venture capital funds on the George Floyd and Breonna Taylor rider. That's a rider that commits both GPs and founders to making a best effort to include underrepresented minorities in their capital structures of startups. And one of our growth equity managers trains its portfolio companies on diversity and inclusion. So the usefulness of diversity is broader and different networks for deal sourcing. It's also different strategies based on different perspectives and life experiences. And with manager selection, manager diversity is correlated with outperformance. Josh Lerner from Harvard Business School has done some amazing research on this. I wanted to touch on one last thing, just from a high level policy perspective before we segue to big picture across the panel, is on mental health. Depression alone causes 200 million lost workdays in the U.S. each year, at the cost to employers of up to $44 billion. So as mental health issues spike with the pandemic, institutional investors are increasingly pushing companies to address them. British asset managers like CCLA and Janus Henderson are leading the charge, and it's worth it. Studies show that $1 spent on evidence-based care for depression and anxiety returns $5. I know John has a lot more to say about how racial justice and economic justice will be crafted in a way that impacts capital, but let's first hear from Huey on the environmental big picture. There's talk of rejoining Paris, carbon prices, but you're really the expert, and can you help us navigate what we can expect big picture from the federal government in the next 4 or 8 years?
Sure, thanks, Bhakti. So one of the first things that Biden has already said he would do once he becomes president is rejoining the Paris Agreement. And as Samantha mentioned, one of the key kind of climate policies that is widely expected is going to be the introduction of a carbon price at the federal level to reduce greenhouse gas emissions. A number of states and local jurisdictions actually already have carbon prices in place. And this is something that actually does have bipartisan support, which is something that a lot of people don't realize, given sometimes the rhetoric around carbon pricing. A number of companies have also joined the call for a carbon price to enable the market to more efficiently and effectively price in this negative externality, and that includes oil and gas majors. So to date, over 50 different carbon pricing bills have been introduced, including at least 8 in this last congressional, in the previous Congress. Many of them, so I think basically it's not going to be a question of will a carbon price be introduced. It's going to be around how is it structured, what does it cover, how quickly is it going to rise, and also how will the revenue be used. There's been a lot of different proposals with different starting prices, different kind of increases over time, and a huge debate is actually around the use of proceeds from a carbon price. So there's been discussions about whether it can be used to fund, for example, infrastructure, as well as whether it should be returned as a dividend to the American public. For those interested, a website called priceoncarbon.org has a great historic summary of the various kind of proposals if you're interested in learning more. The Biden administration has also issued a plan for a clean energy revolution that also includes a number of other climate and environmental related policies. So some of the examples include curbing methane emissions in the oil and gas sector. Methane is a lot more potent than carbon. And so, reducing methane emissions is going to be really critical. There's probably going to be additional energy efficiency standards for appliances, vehicles, buildings, among others. There's also going to be a lot of focus on research and innovation into clean energy, sustainable fuels, including biofuels, carbon capture, removal, and sequestration, without which we're really not going to be able to reach 1.5 degree warming. And going back to what Jon mentioned, there's also a lot of focus on environmental justice for low-income communities and communities of color that often face higher levels of pollution and other inequities. And there's going to definitely be a focus on stepping up environmental enforcement. So a lot is going to happen over the next few years. And we're also going to, as Samantha and Jon mentioned, see the reversal of a number of Trump administration policies and executive orders related to the environment.
Great. So before we move on to the other speakers to address the big picture power of the federal government, we only have 7 minutes left. So why don't you just give all of us a call to arms? Your comments are pretty inspiring. So what can we do? What one thing or two things would you advise those in the audience who are inspired by your work to do?
Is that directed at me?
Yes.
I definitely think, I oftentimes think about how what we as individuals can do. And one of the things that I did when I was at Citi is really push the company to adopt to add an ESG option in our 401k. So think about the ability that you have as individuals to kind of influence the people managing your money, even if it's on a small scale. That really kind of help drives change for everyone. So that's definitely one thing. I definitely think making sure that your representatives in Congress are supporting a carbon price and supporting environmental justice and other kind of clean energy revolution initiatives that the Biden administration would like to pass is also going to be really, really helpful.
Great, thanks, Hui. So Jon, we have 3 minutes for two big questions. Let's speak about the big picture power of the federal government with racial and economic justice, and then a call to arms.
I can't do that in 3 minutes, especially, I mean, look, I swore I wasn't going to go here, but the other day we had the ultimate example of racial injustice in the United States, right? I mean, we've all seen the pictures of the Capitol steps for a peaceful Black Lives Matter rally versus an attempted coup d'etat and domestic terrorism and how that was treated differently. The Biden campaign made it clear that racial justice and economic justice were going to be watchwords across the administration, not ghettoized into a particular place. So every place is going to have it. The Small Business Administration is going to change what they do. Purchasing power is going to change. You've already seen a cabinet that looks a little bit more like America. And I'm not saying this, I'm not a Biden campaign official. I'm just saying this is what we've seen. And we've spent a lot of time on climate, and there's also some just transition, climate justice, but there's also the human capital management issues and rights to unionize and a whole host of areas. The mayor also was just nominated to be the labor secretary. That's going to change things. So what can you do? This sounds really old school, but communicate, and not just, as Hui said, which is every bit as vital, on big things like to Congress or to the SEC. But it is amazing how few people use their individual rights. I've been a mutual fund trustee for more than 10 years. I have never received a letter from any of the mutual fund investors saying we care about these issues. Write to them. Write to FASB and the PCOB, as Sam said, to say, we want you guys to issue guidance about how these things should be done. The old-fashioned way, a first-class stamp is 55 cents. An email is even less expensive. Just do it. You may not think it does anything. Let me tell you, The directors of the mutual fund on which I sit got 10 letters from investors after never getting any. They pay attention. We're out of time, so I'll stop and Sam go.
So Sam, big picture power of federal government and
Well, I second what Huey and John have been saying. Participate. That is the word. Participate. And not just at the congressional or lobbying level, but absolutely be writing to the SEC. Follow the work that the PCOB does. Be writing to the PCOB. Be writing to the FASB. The FASB does not hear enough from investors, and therefore they have not necessarily promulgated accounting standards that give you all the information you need about human capital, about climate and other matters. Start communicating with them a lot more. They need letters, they need, and not just a short one-liner letter that I care, although that's helpful, but really you know what matters to you in the work that you do, and can impart that information, impart those insights to the regulators so that they can act on it. The only reason we have this new human capital disclosure and regulation SK is because an investor coalition filed a petition back in 2017 giving detailed evidence about why they needed more information about human capital disclosure. That should be a model, and just keep doing that. Don't hesitate to reach out to me if anybody wants to talk about, specifically how that can be done with these agencies that might seem a little impenetrable and filled with jargon, but happy to help in that respect.
Bhakti, can I just add one more thing that participation does?
sure.
Regulated agencies face regulatory capture. The industry communicates with them all the time. And yet they were created to promote a public value, not just an industry. And if they don't hear from the public, we just enable regulatory capture. So as in so many other things, silence is not neutral. Silence allows regulatory capture. So if one letter a year would make a difference. Thanks.
So the other thing that I'll just say is regulatory capture is really powerful, but so is ideological capture.
Mhm.
So for all of the corporate centers at different schools, there can also be public interest related centers. So anything you can do in terms of giving guest lectures or helping the up and coming generation train and get familiar with these issues would be hugely powerful and helpful in driving change over time. So thank you to all of our esteemed panelists for helping us navigate all of the seismic changes that are ahead of us. And thank you for Impact Capital Forum for giving us the space to have this conversation. And thanks to everyone in the audience for your great questions, which we integrated into our discussion, and for keeping up the good fight. Have a great weekend, everybody.
Thanks.
Great, thank you.
Thanks.